Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Budmi, my colleagues Nigel and Reema. Guys, hi, morning.
Hi, morning.
Hi, morning. Well, there was no Trump post, right, on Iran overnight? Not yet, right? Well, that's good news. I guess that's status quo. But there's so much to talk about AI, and the gap between the AI haves and the have-nots just seem to be widening day by day.
Well, that's right, guys. So we get through today's trading session, go in for a bit of a break and come back on Friday. But
and it's the sensex monthly expiry today. That got preponed from tomorrow to today.
Yeah, that's right. So it's going to be interesting with regard to the market share as well. But we had one expiry yesterday. Today, another expiry. Let's get straight to the action.
Absolutely. And I think it didn't go well. At least I think some amount of expiry action, expiry-related moves yesterday. The market selling off from the day's high. And we'll get to that in just a bit. So oil prices are still there, $99. I mean, just like a customary check on the prices as we start every day in the morning. I mean, you know, we are not very different. I mean, over the last 3 days, we've basically been around these levels, 97, 98, 99. Fox News basically saying that that President Trump is going to meet with his entire cabinet later today. So it was apparently supposed to happen at Camp David. Now it's happening at the White House. But apparently the full cabinet is going to be present. And they're going to take up the Iran issue. I'm not sure what to read, what to make of it, etc. But hopefully this is perhaps a pathway towards, you know, concessions will need to be made. I think that much is very, very clear from both sides. And whether that will require a broader sign-off, we don't know. We'll see. Now, U.S. equities rose to a high. They were, of course, shot on Monday. Yesterday, they traded, and it's a new all-time high. S&P 0.6 up. NASDAQ ending about 1.1% higher. And, you know, that's the NASDAQ composite. But the NASDAQ 100 hit 30,000 for the first time ever. So it's quite incredible. And I just went back and looked at the time when ChatGPT was launched. NASDAQ 100 was at 10,000. So it's basically 3x from the time that ChatGPT came through. You know, I've said this before. We use the word seminal too loosely to describe, I mean, everyday events. And, well, we say, well, that was seminal or that is. But I think this is it. This is one of those events which really is, at least it looks like, 4 years from that launch, changed the world in more ways than one, in so many ways, so many different ways. By the way, the NASDAQ 100, and, you know, just take a look at this. Yesterday, when the NASDAQ 100 hit 30,000 for the first time, 50% of the stocks were in the red. So, again, I mean, within that bunch of stocks, which are all primed towards sort of, you know, servicing AI in one way or the other, even within that, it's a kind of sort of narrower set which is doing well. Anyway, the index is up 19% this year so far. That is the index, and it's the second best start to the year in 25 plus year. That's quite something. And just talking about that, Micron is the latest trillion-dollar company. It was up 19% yesterday after earnings and a couple of brokerage upgrades, etc. But $1 trillion in market capitalization. So memory has been the name of the game, at least for the last year and a half. And Micron very much at the heart of it, at the center of it. We've seen this, of course, with Samsung, you know, SK Hynix and others as well. Now, just some macro commentary. This is not very much. I don't think it moves the needle in that sense, but you know, a Fed voting member said that a prolonged Iran war could spur a series of U.S. rate hikes. You know, the 10-year was flattish. I mean, not very, I think about 2 basis points changed. The rupee pulled back. I mean, it had about 2 or 3 days of very strong gains. But yesterday, of course, ended weaker, 95.68 compared to 95.23, which was the close on Monday. So we'll see how we start this morning. But, you know, as we go into the holiday, once again, expectations are in the direction of perhaps progress towards some sort of an agreement, some sort of a deal being made. But how much do you trade anticipation? How much do you trade hope? And how aggressively can you do it? That's the question. Even last Friday, if you remember, as we were heading into the last weekend, the Nifty ended about 90, 100 odd points higher. It's basically on the back of hopes that, you know, something positive comes out. Some positive did come out, at least in terms of commentary. And Monday, the market followed on with more gains. But, you know, so we're in that general mood, general frame of mind, even now, that perhaps the direction of travel is towards de-escalation, etc. So tomorrow is a holiday. The resistance 24,300 and the support is 23,800 or so on the downside. That's a range. I mean, we've sort of bounced around up and down, below and above these levels so many times in the past. But those are pivots, at least in the very, very near term. Nigel has walked across to the wall with a quick sense of how the futures and options positioning is looking. Nigel, take it away.
Well, May was a flattish month, and yesterday's downtick will be attributed more towards the monthly expiry that played out. But June seasonality remains moderately conservative. And over the last 10 years, if you look at it, the Nifty has delivered positive returns in 60% of the June series, average return of close to around 1.5%. The bulls will hope for the same to continue. In terms of the rollover picture, the Nifty futures rollover stood at around 70%, more or less in line with what we've seen in the past, though the short rollovers continued. And there is some aggression on the short side as well. That was clearly evident, though in absolute terms, 70% is in line. Even if you look at the Nifty futures open interest, at the start of the series, June is similar to what we saw in the month of May. So no big change out there, as heavy, as light as what we've seen in the previous series. Well, the FI positioning on the future should come up for you on the screen. And they're a little less short, if you look at it, at the start of this series in compared to the May series. So they're short, but a little less short in absolute terms. Though on stock futures as well, they're a little less net long. So that mix continues with them being net long on stock futures as well as net short on index futures. Clients, in terms of the futures action, well, they remain net long, almost similar to what we saw at the start of the previous month. But on stock futures, their long positioning actually is a little bit higher than what we saw at the start of the last series. That's on the stock futures. So the broader market setup remains positive. Stock-specific opportunities likely to continue rotational leadership as well as likely to dominate market behavior. And this is going to continue to remain a very stock-specific market. In terms of levels, the recent low, that's on the 13th of May. That's going to be the first reference point on the downside, in terms of you don't want this level to get breached. But the first reference point will be the 50-day May. That comes in at around 23,680 or thereabouts. On the upside, I think the bears are positioned that they won't let this 24,250 to around 24,500 mark to get breached. And the Nifty Bank's role is going to be extremely crucial because 2 sessions back it went ahead and it conquered that 20 as well as 50 DMA. Yesterday it pulled back 250 points, but it continues to hold about those levels. So it's imperative that the Nifty Bank holds on to its own, get some support from Reliance Industries, and that's what could take this market to around the 24,500 odd mark. The odds at the start of the series are stacked towards maybe a bit of a positive bias. Cues to track, the monsoon is going to be important, the upcoming RBI meeting is going to be important, and the street is factoring in a more or less status quo out there. ECB as well, they're widely expected to hike interest rates out there. So those are the central bank action, RBI, Fed, as well as the ECB. Well, if you look at the weightage, on the MSCI Emerging Market Universe Index, the Taiwanese index clearly, as well as the Korean index, because of the AI play, there's been a big increase over the last few years. While India, well, the increase hasn't been that much. But keep in mind, in 2024, India's weightage went from around 8% all the way to around 20%. And, then, in fact, we have come back down to around this 11.2% or thereabouts. And if I plot the chart of the MSCI India versus the MSCI Emerging Market Index, it's now at the lower end of the rising channel that we have drawn all the way since 1996. In short, IFL had pointed this out in their overnight note, and it appears that the risk reward could turn favorable for India with this underperformance from the emerging markets. So we'll have to see how that goes, but that's an interesting statistic that they put out there, IFL Alternative Desk. So we'll keep an eye on that.
All right, thank you very much for that. Taiwan overtaking India in market capitalization is a big story, and this is at a time when India's GDP is 4x that of Taiwanese market. A quick check on the GIFT Nifty before we proceed, suggesting, I think, a mildly lower start. Yesterday as well, the benchmark indices lost about 0.5%, but the good news is we held on to support levels and now 85 points lower on the GIFT Nifty. A check on Asia before we get things going. It was fresh highs on Wall Street, but it was all to do with AI. So it was names like Micron, 20%, Seagate, Broadcom, AMD, which is why this morning, again, you can see the gains coming through in the Taiwanese market. That's up 2.7%. Kospi is up nearly 5%. The Japanese market, too, is up nearly 1.5%. So the digital divide between the AI winners and losers seem to be widening. We'll talk more about it, but let's get in our first guest on the show. That's Candice Browning, Head of Global Research at BofA, joining in on the show. Thank you very much, Candice, and great to have you on CNBC TV 18. But first, about the economy, and markets seem to be surprisingly resilient despite rising geopolitical uncertainty around US-Iran situation. It's been nearly 3 months now. Do you think, in a way, investors are underestimating the macro risk from a prolonged energy shock, or is the market effectively betting that this remains a contained event? What's your own view?
Well, yes, I think, we just finished doing a global fund manager survey. So we actually surveyed more than 200 institutions that manage, over $500 billion in assets. And the results were quite interesting this month. Basically, about 54% of the respondents expect the Strait of Hormuz to be fully opened by the end of June. So investors are, effectively looking through the problems with the strait, and they think that it will be opened and that therefore oil prices will probably, decline and end the year somewhere around $85. So whether that's optimistic or too optimistic or not, I guess we will definitely find out. But, this data point shows you clearly that investors are simply, looking through this. And basically what's happened is, rather than focus on the Iran war, they're focusing on the continuing proliferation of CapEx around AI infrastructure. So there's been a trade-off between those two.
All right, Candice, got that. Well, let's focus on another aspect then. One of the biggest debates globally right now is whether we're entering a stagflationary phase, which means high oil prices, sticky inflation, and slowing growth. How seriously is BofA thinking about that risk, especially for markets like the United States as well as the European economy?
I think it's definitely a risk. I think basically what's happened with this Iran situation is that it's what I would call a stagflation shock. And so, we have a somewhat different outlook about interest rates than we did at the beginning of the year. We definitely think there is more of a tilt towards tightening of monetary conditions rather than the looser conditions that existed at the beginning of the year. However, we think it's still a little bit too early to actually call for rate hikes. So while we're concerned about slower growth and higher inflation, we don't think that there are going to be any Fed hikes this year. We do expect that there will be hikes in Europe, about 50 basis points.
Got that, 50 basis points hikes in Europe. Candice, from an asset allocation perspective, at least up until now, capital is concentrating and moving towards US equities, particularly AI trades. Will that continue, or are you beginning to see a broader rotation into other assets like commodities, other emerging markets, real assets? What's your view on asset allocation from here on in terms of risk reward?
Well, we still are quite bullish on the U.S., assuming that this situation in Iran does get solved over the next couple of weeks. While we see potential long-term opportunity in frontier and emerging markets, we don't really think that that's going to be realized until the situation in Iran is over. For example, as you know, India is very highly dependent on imported energy. So we continue to see that this energy problem is going to hurt some of the emerging markets and frontier markets. Whereas if you look at the US, yes, we do have higher, gas prices, but on the other hand, we're still benefiting from this AI boom. And you can really see that in corporate earnings, which, this most recent quarter were up strongly, double digits. So the earnings growth of the companies in the S&P 500 continues to be extremely robust.
Okay, got that. Candice, let's speak about the AI boom then. From Wall Street to Taiwan to South Korea, almost every major market rally seems tied to AI in some way or the other. Are we still in, early in the innings on this? Or are we running a little bit ahead of expectations? Is it getting into a little of, it's getting a little excessive? And what makes this AI cycle fundamentally different from past tech booms?
Well, I think, if you look back to the internet, the beginning of the internet, actually, a number of those companies were unprofitable, completely unprofitable. A lot of these companies are, in fact, very profitable. Now, you could look at the spending on AI in terms of CapEx right now and say, that's a lot of money and it's not generating, a lot of revenue right now. But the reality is that, this investment is going to continue for 12 to 18 months. We feel pretty strong about that. And obviously, the jury is still out in terms of what the revenue generation capability will be from these new technologies. So I think it's too early to call this a frothy or a bubble. I think the jury is frankly still out on it.
And Candice, what about India? We've seen an FI exodus. Global funds have pulled out nearly $22 billion out of Indian equities just this year alone. Is it purely a relative trade, money rotating away from India into Taiwan, Korea, chasing the AI premium? Or is this a structural shift?
No, I think that India in particular has been hurt by its, dependence on importing energy. So any policy changes that relate to better energy security, I think, would really benefit India. And I think in some also, the losers of this, India so far has been one of the losers as a result of the Iran war in terms of, equity valuations. But, if the war ends and oil goes back down, I think India's got some great structural wins behind it. So I think that the losers of recent months could become the winners, by the end of the year. So we're quite sanguine on the Indian market over the long term. We think these problems are relatively short term.
Got it, Candice. Final question before we let you go. India has been the loser of this AI trade. But like you said, will the war ending and oil prices coming down alone fix these foreign outflow problem? Or what more is required to see the FIs return back to India?
Well, it's not going to 100% fix it, but it certainly is going to have a very, large impact. I think, India in terms of demographics has a lot going for it. And also, with positive policy changes and continued deregulation, I think India would have a lot of forces that would be beneficial.
Let's hope. Candice, great chatting with you. Thank you very much for speaking to CNBC TV18. Look forward to the next one already. Let's get to the interactions lined up on the show today. So coming up, 8:35, the management of Yatharth Hospital will talk about Q4 earnings. 9 a.m. We'll be joined by ICICI Securities Probal Sen to talk about oil and gas space, ONGC numbers. 9:20, Deepika Mundra of M&G Investments will be our market master for the day. 9:30, we speak to Aren Keptian of UBS on markets and more. Following that, the management of EID Parry will chat with us. 9:40, 9:50, another earnings conversation with the management of Acres. Towards the end of the show, Lata will speak to 4 trade economists on whether the spate of FTAs can one day bridge our current account deficit. Stay tuned.
Time to slip into a quick break. We've got a lot of stock-specific action track for you when we come back on the other side. In our top 10 segment, we're looking at Siemens, IRCTC, JK Tyre, Corrado India, Senco Gold and Vodafone Idea. All of them will be reacting to positive news flow, while Coal India, ONGC, Transrail Lighting and Equus will be reacting to negative news flow. Take that break, come back, we get into further detail on all of those names.
Welcome back. You're watching Bazaar Morning Call. It's time to talk stocks. Our entire research team is standing by with CNBC TV 18's list of top stocks for the day. Nigel, you go first. Coal India OFS.
Well, that's right. Coal India OFS has been announced, and our news break here at CNBC-TV18, where my colleague Vivek had broken on May 7th. That's got confirmed. Let's tell you the details. The government will sell 1% stake in Coal India by the OFS route. They'll be looking to sell close to around 6.16 crore shares by the OFS route, and the option to sell an additional 1% stake. The government, remember, currently holds around 63.13% as of March 2026. So if they go the entire hawk, then it'll come down by a couple of percentage points. But just looking at the floor price at around 412 rupees per share. And, at this floor price, the government can garner close to around 2,539 crores odd. But if they go for the green shoe option, then it'll be double of that, which will be more than 5,000 crores. And that is at, the floor price. I expect, the closing price actually will be a little bit higher than that floor price of around 412 because it's at such a sharp discount. In terms of when you can apply, today it will be for non-retail. We'll have to wait by for the cutoff price because that will be the reference point for retail when the OFS will open on Friday, which is the 29th of May. So the stock opens gap down. Yesterday, if you look at the intraday chart, the high of the day was around 475 rupees. It ended at the low of the day. The street had a bit of a sniff. Stock opens up in the red. And then I think we see a good amount of subscription coming in because the government has picked an opportune time to go ahead and sell the stake in Coal India. That said, let's focus on another PSU. Sudarshan joins us to tell us about ONGC. Sudarshan, morning.
Good morning, Nigel. So it was a soft quarter for ONGC, and the main culprit was a sharp drop in the production that we have seen for both crude and gas, and also because of higher OPEX and travel write-offs. This is a sharp drop in we have seen in for both EBITDA and margins. So talking about the headline numbers, revenue has seen an increase of 13.9%, but EBITDA has fallen by more than 17%, and there's a sharp drop in margin. It has come in at 35.3% versus 48.4% that company had reported last quarter. And if you talk about the production, crude production was at 4.95 million tons. That was down 6% YOY and 3% on a sequential basis. Gas production too has fallen 4% sequential basis. Brokerage though largely positive on the stock. Jefferies maintains buy call with a target price of rupees 360. But because of being a soft quarter, I'm going with red.
Thank you very much for that. Vinny, how did Siemens numbers look?
Not so great. Revenue, yes, came in line with expectations, around a 14.6% growth that we're seeing on a year-on-year basis. But the margins, that's where the miss came in, right? The EBITDA margins came in at just 9.62% versus 11.5% last year. Expectation was also of around 11.25%. So clear miss there. Why was the margin a miss? One, we had seen higher commodity costs, rupee depreciation. All of that overall impacted the profitability of the company as well. Now, when you look at the segment-wise performance as well, right, what you're seeing is smart infra and digital industry. Those margins also saw a drag, and that is what led to overall drag in the margins of the company. Order book and order inflow for Q4, that came in at 6,731 crores, which is up around 33%, which included orders from the parent company of around 1,800 crores, mainly in the mobility segment. Apart from that, order backlog for March 31st March 2026, that stands at 45,000 crores approximately. But not a great set of numbers, missing the margin expectation. We could see a downtick coming in on the stock.
Thank you very much for that. Let's go across to Devyani now on IRCTC.
Well, a good set of numbers coming in from IRCTC. Now, the revenue growth has surpassed management's FY26 guidance of 10% revenue growth on a year-on-year perspective. Now, this is primarily as a result of the Q4 being good, with revenue growth of about 15% year-on-year, driven by strong catering performance of the company. Now, EBITDA increases by 6% this time around, but margins have been weak across the ticketing, catering, as well as the tourism business of the company. Now, PAT is down 9% on a year-on-year perspective, but that's primarily as a result of a 46 crore exceptional gain that was seen in Q4 of FY26. So all in all, a good set of numbers coming in from the company, going with the green on IRCTC in trade today.
All right. Thanks very much, Devani, for that. Well, JK Tyre and Carraro India are the next two names we want to focus on. Sud is here. Sud, morning.
Morning, Prashant. So it was a good set of numbers from both JK Tyre and Carraro India. So first, talking about JK Tyre's India business continues to lead the growth, and this segment forms almost 90% of total revenue. So overall revenue has increased by 12%. EBITDA has seen a jump of 48%, and gross margin too has increased by 230 basis points YY. On a sequential basis, though, it was a minor fall. Talk about the segments. India business revenue was up 15%. Margin here has increased by 300 basis points, and Mexico business that forms around 10% of total revenue revenue. Their revenue was down 16%, but margin here too has seen an increase of 120 basis points. Coming to Carrado India, it was a strong growth. Both the segments, domestic as well as exports, especially exports, that segment has seen a growth of almost 70%. And because of that, company has reported revenue increase of 37%, EBITDA has seen a jump of 45%, and margin has increased to 11.6% versus 10.9% in the same quarter last year. Two major segments, agri vehicles, for their revenue has increased by 37%, and construction vehicles revenue too has seen an increase of 36%. So I'm going with green for both JK Tyre and Carrado.
Thank you. For more earnings, Vinny is joining in.
Hi, so first up, we'll talk about Transrail Lighting. Red expected here as well. Revenue declined by around 4% on a year-on-year basis. Margin have fallen by 90 basis points. Overall, weak numbers have just come in from the company. FY26, though, the management had given a guidance which they managed to hold on, but nothing exciting in terms of numbers. Their order inflow coming in at around 8,500 crores for the full year. An order book includes an L1 order of around 16,361 crores other L1 orders for the period of FY26. All in all, we'll see red here. Senco Gold, that's the next one. We are expecting it to open up in the green. They've seen a strong performance coming in Q4, 45% revenue growth. Margins have come in at 13.7% as well. There's a bit of an impact in Q1 that one could expect now of custom duty hike. Management commentary, they remain optimistic on FY27, expecting around a 20% revenue growth, and margin guidance of 7.5 to 7.8% for FY27 is what they've given. So some bit of green here as well. Equus, that's the company that we'll watch out for on the back of the numbers. Revenue was better than what the street was expecting, but here profitability was weaker than estimated. Consumer segment of theirs, the margin saw a sharp decline coming in. Revenue, the sharp rise in inventory impacted the overall cash flows of the company. So we are expecting red here, and the management expects revenue growth of 45 to 50% is what they've guided in their con call. So that will be key to watch out for. But as of now, nothing great in terms of numbers versus what the street was expecting. So red here as well.
Thank you very much for that. And a quick word on the telecom subscriber numbers for the month of April as released by the TRAI, Telecom Regulatory Authority of India. I think the key standout is Vodafone Idea, because Vodafone Idea has managed to add subscribers for the third consecutive month. So in April, they've added about 53,000. This compares with a 1 lakh addition in the month of March, and in February as well. It was the first positive month after a very long period of bleeding subscribers. So for Jio, largely steady, around 3 million. Bharti has seen a drop in April at 5 million, at 3 million versus 5 million. But March was particularly strong for Airtel. But as I said, the standout is Vodafone Idea, third consecutive month of positive subscriber addition, and the street will want to see this continuing. So let's do a quick recap then of the top stocks. Stocks with positive news flow are IRCTC, JK Tyre, Carrado India, Senco Gold, Vodafone Idea. Stocks with negative news flow are Siemens, Coal India, ONGC, Transrail Lighting, and Aegis. That's equities. What about commodities? What's happening here? Manisha is now joining in for a complete roundup. Manisha, good morning.
Morning, Ima. Thank you for that. Well, I'll start with the crude oil prices, where we continue to trade below $100 a barrel, even after some gains that we saw in the markets yesterday. Well, it really has to do with the U.S. Secretary of State statement saying that it could take several days to complete the peace negotiations therein. There are some unresolved issues like Tehran's frozen assets and unrestricted passage through Hormuz. In the meanwhile, you also have seen gold and silver prices kind of trade steady. Gold is back above 4,500, so is silver at around 77 to 78 $78 an ounce. Markets actually now pricing in a 40% chance of a U.S. Fed rate hike in the month of December. But the gainer in the segment clearly is the base metal prices. The dollar index has eased a bit. The Chinese data has come in on the positive side. The Asian equities are climbing to new record highs. And the tech-led rally on Wall Street does tell you that the AI and the related technologies are going to be using metals way more than what the earlier estimates were. So that is exactly where copper, aluminum, zinc seem to be getting their support from.
Okay, all right. Thanks a lot for that, Manisha. Well, time to slip into a short break. On the other side, the management of Yatharth Hospital will be waiting for us. Stay tuned.
Okay, welcome back. There's 30 minutes to go for the pre-open session. Yatharth Hospital is the first management on the program. The company's reported the highest ever revenues. It's also guided that newer hospital mix will elevate the group average revenue per occupied bed. Yatharth Tyagi is whole-time director at the company. He's with us now. Mr. Tyagi, great to have you with us here. Thanks for joining us. Could you just sort of, break this up for us? New hospitals, which is Faridabad Sector 20, New Delhi, Greater Faridabad, contributed about 22% of revenues in FY26. What was occupancy and what is EBITDA trajectory and break-even timelines here?
Good morning. Thanks for having me. So yes, the three new hospitals that we have started, as you mentioned, have been a major contributor to this 46% YOY, growth that we've seen in the quarter four growth that we've seen. These three hospitals specifically, if we talk about today, Faridabad Sector 88, which technically lies in Greater Faridabad, is a hospital we started around 15 months back. This hospital has today, broken even. In fact, for this financial year, this hospital is also PAT positive as far as P&L is concerned. The other two hospitals, the Model Town Hospital in New Delhi and the Sector 20 Faridabad, which combined together have a capacity of 700 beds, have been started in this financial year. And both are showing great occupancy. We feel that probably in the H2 of the new financial year, these two hospitals will also be break-even. As far as occupancy is concerned, both hospitals are showing a decent amount of ramp-up, both having upwards of a 30% occupancy as we speak today.
So Faridabad Sector 20 and the New Delhi Hospital, the new ones, break even in H2 of FY27. Now, there is a big gap between your consolidated margins, which stand at 21.9%, and the margins X of these new hospitals, which is 30%. Now, as we progress towards break even, what would consolidated margins look like, Mr. Tyagi, in FY27? Could you help us with a broad range or a number that you're targeting?
As far as margins concerned, I think even for this quarter four, we are on track as far as our guidance is concerned. For the full financial year for 26, we mentioned we would be somewhere around 24-25%, and we are on that track. For the coming years also, we feel that the EBITDA margins would also be in this trajectory. However, we are quite confident that in the coming financial year, the EBITDA margin should show some upside. As I mentioned earlier, these two new hospitals would be break-even. So the EBITDA drag of these two hospitals will not be from the H2 of the new financial year. So we do see an upside in the margin for the coming years, somewhere between 24 to 25% would be a right guidance.
So you're maintaining your margin guidance of 24 to 25%, but you're saying it will be higher than FY26 margins of 24.2%. So you should end closer to 25%.
The reason for a higher margin than FY26 is, the EBITDA drag for these two new hospitals. And it's also important to note the new Agra hospital that have, just been operationalized this quarter four is already, a EBITDA positive hospital since we started it. It was already a running hospital. We acquired a running asset, and in quarter four, it has shown a margin of somewhere around 16%. So that will also contribute significantly going.
What about the revenue guidance, Mr. Tyagi? Last year, you did about 36%. This year, what are you looking at?
We have a lot of, room as far as the revenue growth is concerned. The major reason is the growth in the RPOP. Another reason is the ramp up of the new facilities. We have added around 1,000 beds as far as financial 26 is concerned. So in the coming years, the huge ramp up of these new beds will be seen. I think we're quite sure the 36% YOY growth that we have shown this year, we should be surpassing that growth.
Right. Bottom line, you've put out a number, Mr. Tyagi. What is the guidance?
Yeah, I think the company has shown tremendous growth as far as the CAGR for the last 3 years concerned. I think for the coming 3 years also, as far as bottom lines and numbers, we should be maintaining that trajectory.
Okay. And you said you want to get to 5,000 beds, right?
Yeah, so currently with the 3 new hospitals operationalized this year, we are 2,600 beds. The announced capacity is 3,200 beds, which includes the new acquisition of Gurugram that we recently done, which will be operationalized from the first quarter of FY 28, as well as the Agra and the Model Town Hospital. There's a brownfield expansion also being planned for the Greater Noida and Noida extension. So announced capacity today stands at 3,200 beds. We do target 5,000 beds in the next 3 years, but I think we should be able to achieve it much earlier.
Sorry, operational beds are how many? 2,600?
The total bed capacity today of the group stands at 2,600 beds.
And you have given a guidance for another 900 beds.
Yes, yes.
And so you have visibility in terms of how you're adding these 900 beds right now. So that's...
These are done deals. So these are on track. They just need to be operationalized here.
And the next 1,500 beds after that?
Would be coming in, as I mentioned, would be a mixture of acquisitions as well as brownfield and greenfield. These would be primarily in the areas of North India, primarily in Delhi NCR. That's where we have presence. In the past, we have shown and we have followed a cluster-based approach. So, today we have 3 hospitals in Noida, 2 hospitals in Faridabad. We have started a new cluster in Gurugram. So, we believe in being the largest players in the cities we operate. So, we would follow the cluster-based approach to reach this guidance of 5,000 beds.
By when, Mr. Tyagi? 5,000?
See, the guidance is for the next 3 years, but we are quite sure the company should be achieving it much earlier.
So, this is 27. By end of 28, you should be 5,000 beds?
I think before 29, that's the target.
Calendar 29.
Yeah.
Okay. Your debtor days also improved. It stands at 112 versus 125 days. Could you tell us what helped in the improvement? Was it the payer mix shift, collections improved? And when do you get to 100 in terms of debtor days?
There's a mix of all the 3 things that you've mentioned. Yes, there were improvement in the payment cycles as far as certain government schemes are concerned. Also, we did see a shift as far as the bigger pie of private insurance, international patients, and self-pay patients increase in our revenue. Debtor days did come down because of that also. Going forward, we are sure of bringing these debtor days somewhere close to 75, after 2 financial years are concerned.
Okay, so 75 is the target, but after 2 years. Thank you. Thank you, Mr. Tyagi, for joining in and wish you all the very best.
Thank you.
All right, let's get into a short break. On the other side, we'll connect with Deven Choksi of DR Choksi FinServe. Stay tuned.
Welcome back. Hope you're having a good morning. We start off a new series. That's a June series. And history suggests it's been more positive than negative over the last few years. Though for starters, we're likely to pull back close to around 80 to around 90 points or thereabouts. But let's go across to Hormuz. He joins us to tell us about all those big movers yesterday. And Hormuz, some backed and some not backed by delivery. Go ahead.
Morning, Nigel. And Adani Group stocks have been doing fairly okay for themselves over the last couple of days. And Adani Total Gas is one of them, was among the top Nifty 500 gainers on Tuesday, with the 4th straight day of gains for the stock, the biggest single-day gain in 3 months. The volumes were the highest in almost 2 months as well. Close to 3 crore shares were traded on Tuesday. It was well over 6x its 20-day average. 15% of those were marked for delivery, and around 43 lakh shares for delivery. The 20-day average is around 7.5 lakh shares. It was the 4th most traded stock on the Nifty 500 on Tuesday. And of course, from the March 30 lows, the stock is up over 40% as of closing yesterday. Concor is the other one. It was an earnings reaction, a negative one at that. The stock was the 2nd worst performer on the Nifty 500, down over 7%. The biggest single day fall since June of 2024 for the stock. On the put option side, the premiums were up almost 130% on Tuesday. Volumes were the highest since November of 2025. Over 90 lakh shares were traded on Concor yesterday. The 20-day average is just over 12 lakh shares, and 36% of those were marked for delivery. So around 33 lakh shares for delivery. The 20-day average is just over 6 lakh shares, and the stock over the last 12 months is down over 20% and nearing its 52-week low, which is at 421. And lastly, Bliss GVS Pharma, a news flow driven name. The stock was up around 5% on Monday, but yesterday's session, the stock was in an upper circuit of 20%. The biggest single-day gain since July of 2015 for the stock. It was the 5th straight day of gains, and in these 5 days, the stock is up 35%. Volumes were the highest since the start of the year. Over 1.5 crore shares were traded, well over 5x its 20-day average, and a third of those were marked for delivery, so close to 50 lakh shares for delivery. 20-day average is around 10 lakh shares, and the stock also, with that 20% upper circuit, ended at a 52-week high.
Thank you very much for that. Deven Choksi is now joining in as promised. Deven, good morning. Thank you for joining in. Any view on the Adani Group stocks? All of them have been doing very well, whether it's Adani Enterprises, Total Gas, Green, Adani Power. Stocks have seen some solid upward momentum.
Yes, Seema. Good morning. Well, I think fundamentally, none of these companies were ever in doubt, despite of, I think, whatever the selling situation on the global front, particularly on the SEC, DOJ front, that they were having. I believe that I think having cleared the all embargoes, particularly from SEC and DOJ, and also from the foreign accounting practices. So from that asset practices, from that particular point of view, I guess I think that 2 or 3 possibilities are emerging. A, the company, particularly Adani Enterprise, going for demerger of the businesses, including the road first and thereafter the airports. They should be fairly attracting the capital both on equity side as well as on the debt side. The other assets also, I think, equally importantly, the power assets, I think the renewable power, the green power as well, I think they are also going to be attracting larger amount of fund flows. This was up till now a little bit circumspect because of the fact of the embargo that was there. Now with this embargo going in, probably you are seeing the possibility of higher amount of equity, of course, and repricing of the debt. And that's where probably the market is justified in taking the stock prices to the higher levels. We believe that the fundamental story remains intact with the EBITDA compounding at the rate of 20% at the group level, which is, I think, sounding quite reassuring because the cash generation is happening very systematically and very high at this point of time and giving promises for higher amount of capacity build-up going forward.
Okay, got it. Hi, Devin. Good morning and good to see you. Devin, I wanted to ask you about a couple of these other names, particularly the PSUs. We've been talking about this in the past. Coal India as well as ONGC, they could be candidates that the government comes in to sell because of the tailwinds that you're seeing temporarily. And they've gone ahead and they've bite the bullet. In fact, my colleague Vivek had given us a heads up close to around 20 days or so ago when he said that they could do an OFS. Now the OFS announced, and the good news is it's at a sharp discount, 412 rupees. Would you advise investors to go ahead and apply in this OFS when it opens for them on Friday?
Well, I guess I think the business-wise, Coal India particularly is doing very well. I believe I think the higher amount of the production is also giving a good amount of visibility on the volume-led growth for the company as well. And around 400 levels, practically the downside will be limited. So in a way, I think that will be a buy opportunity. However, the larger challenge remains, I think, how many green funds globally would be participating into this asset. I think that remains to be seen. But locally, I believe that I think the issue is priced attractively at close to around 400 levels. So I think certainly one should go for it from investment perspective.
I see. Got that. So that is the... Devin, hi, morning. Hitachi and GE Vernova, do you have a view?
So both the Hitachi Energy particularly, I think, saw the numbers and probably very impressive numbers, of course. And nothing that has completely surprised me because I think they have always been carrying a good amount of order book, which they continue to show the visibility for next 2 years easily. So from a perspective of looking at, I think this entire business is both GE T&D or GE Vernova and the Hitachi Energy, including, I think, companies like Siemens Energy. I think we believe that they are probably heading for one of the best times going forward in the next 5 years because the way in which power infrastructure, power utility infrastructure is getting built into the country. Some of these companies are getting the best of the times, I think, as far as their order book position and their execution is concerned. So we remain structurally bullish about them. Maybe the valuation-wise, one is arguing that, yes, I think they are adequately priced or fairly priced. But if one is looking at, I think, 5 years in view from now and execution thereon, I believe that I think some of these companies may offer opportunity at lower levels during the market ups and downs.
David, what about Bliss GVS Pharma? The open offer price by Anupam Rasayan is $299. The stock today is at $381. In fact, since the deal is announced, on Monday it was at 300 rupees, and in 3 days it's rallied to 381. 2 days now. Today would be the third day. So what's the play here now? Does it make sense to buy Bliss GVS when it's trading well above the open offer?
I guess I think the Anupam is getting properly integrated with this formulation company, which is having the presence in other parts of the world. So certainly, I think that's an advantage that one is getting. And in my viewpoint, I think that's a strategically important advantage that the company is talking about, Anupam is talking about. So from that perspective, I think Willis Pharma definitely remains an important play going forward as well for Anupam. Though I think the numbers probably at this point of time not very easy to compare, but we believe that I think the deep integration is in offering, and that is where probably we like the company from a perspective of long-term investment. Maybe currently things are adequately priced, so one may not immediately jump into it. Correction in the stock price could be better opportunity.
Yeah, yeah. You know, the Tata board meeting yesterday, right, Devin? So sources tell us that there were presentations made by Air India, by Tata Digital, Tata Electronics, but also Tejas Networks. Now, Tejas Networks is listed. We reported on it yesterday morning before the board meet started. Tejas was up about 5-6% yesterday. You know, the thing, of course, with Tejas has been the long wait for the next BSNL tender, that order. But it's a strong company with IPs and technology base in that sense. But it's not done well. From the lows, it's come up quite a bit, from 300 to 500. Any thoughts here, Devin?
Yes, Prashant. I guess I think all these companies which are driven on the data center theme actually. Tejas, HFCL, and for that matter, even Sterlite Technologies. Each one of them probably up till now have been sluggish and moving upward because of I think the customers not placing enough orders. But given the fact that in next 5 years, the amount of data center capacity which is coming up in the globe, and these companies are well positioned themselves into applying all the solution, including the networking and the complex solution therein. I think they are favorably placed. I'm not too sure as of now as to how exactly the numbers will unfold for all these companies, but really they remain promising. I've never seen this kind of strong order book for companies like Sterlite Technology or for that matter even HFCL. And so is situation with Tejas. So I would like to believe that I think things are shaping up well. Maybe once the number comes, we'll probably have more comfort in putting up a song like a
Okay, all right. I want to ask you, Devin, about the real estate pack. You know, Suntech Realty, I was looking at an advertisement that they put out in the papers today. They have launched that long-awaited project near Nariman Point, you know, which will be coastal facing. I recall the promoter entity put in money at more than 400 rupees. The stock is closer to around 300 rupees. What's your view on the real estate pack, and if any view on a company like Suntech Realty?
I think in general, we remain extremely bullish about the prospects of real estate company, and particularly the companies which are into luxury and ultra-luxury segment. Because what we are observing that affordable in the premium segment, wherein I think the masses are getting into, they have the challenging form of selling at times because I think higher amount of inventory. But the luxury and ultra-luxury segment is attracting fairly good amount of demand from majority of the high net worth consumers, I think, that we are experiencing. And in my viewpoint, I think some of the companies like Oberoi, or for that matter, even Steel Lotus, which is typically, I think, predominantly positioned in Mumbai market at this point of time, but generating a significantly large amount of per square foot realization, which we observe in case of Lotus. They collected about 69,000 rupees per square feet realization, which is highest in the industry. So such kind of companies, they remain distinctly favorable as far as the portfolio addition is concerned. And we like them from the long-term investment perspective.
Got that. Devin, yesterday we got the Vahan data for the auto pack, the Vahan registration numbers for May so far, and very strong numbers. Sudarshan, I remember saying that this month could be the best, May 2026 could be the best since May 2018. So in the last 6 years, and we could see double-digit growth across the various segments. So passenger vehicles in particular could be a 20% plus kind of growth. Any view on auto names from here on? So at least it seems like the volume momentum that picked up post GST is sustaining even in the month of May.
Yes, Rima, absolutely. I think 20-23% kind of a growth by TVS, Bajaj, even Hero. And even I think Ola has gained some part of the market share, I think, in this particular month. So I'd like to believe that I think there are two different things which are happening. One important thing, the new buyer is moving towards the electric vehicle. That's where probably I think you are seeing the larger amount of growth numbers coming in as well. Your players like Bazaar, I think the numbers are also coming in from the three-wheeler which they have launched, the electric three-wheeler which they have launched, which has possibly given them maximum amount of profitability advantage in this particular situation. So we believe that I think this two-wheeler as well as four-wheeler, and particularly electric vehicle theme, is going to unfold big time in coming years. And that is where probably we would like to stay with some of the stronger companies who have got the best of their abilities in manufacturing and product launches, and at the same time distribution. So that's where I think our focus remains with companies like Bajaj and TVS for that matter.
All right. Devin, we leave it there. Thank you very much for joining us. Good speaking with you. It's a pleasure. Well, we'll take a quick commercial break here. We'll come back with a pre-open. We'll have ICICI Securities' Prabal Sain join us in the oil and gas space. Mitesh and Sudarshan will be with us as always with the technical view. Stay tuned. Okay, well, 16 minutes to go for the market open, 2 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they'd want you to do as we begin this new session. Gentlemen, good morning. Great to have both of you here. Sudarshan, maybe a bit of, you can blame a part of yesterday's move to expiry, but what do you do? I mean, we seem to be in this 23,800, 24,300 kind of band.
Yeah, good morning. Well, yesterday was a disappointment. The market broke out above 24,000, stayed above 24,000, and then 24,100, and then retreated. Now I can also comfort myself by saying it was expiry, as you said, or X or Y or Z. But that doesn't change the fact that the breakout failed after being almost decisive. That's very, that creates a setback for the analysis. As of now, if you have long positions, close them out if you still have them, and just step aside.
All right, step aside. Mitesh, were you also a little disappointed? The fact that we gave up yesterday, we couldn't quite consolidate on the gains with an upward bias. What's the call for the day?
Good morning. I was, in fact, we've been struggling to get past 23,850 on the Nifty, and then when we broke out, kind of immediately retreated. So we are still above this 23,850, 800 zones. So there's still some hope for me. What I would look for closely is the movement of the bank Nifty. On the banking names, on the charts, many of them are looking quite strong and showing some reversals on the hourly, 2 hourly, 3 hourly chart. So I think there is a good chance that if the banking stocks could recover fast after a mild cap down decline as the GIFT Nifty is indicating, then I think we might have some thing positive to look forward to. The bank Nifty has got good support around 54,500, 600 zones. So in case we drop about 300-400 points from here and then recover, I think I'll be aggressively going long, especially on the financial news.
And stocks, Mitesh?
I have more of buy calls today. Canara Bank, and I was talking about banks. So Canara Bank is one stock which can be bought with a stop below 129.5 for targets of 140. Also a buy on Interglobe Aviation with a stop below 44.25. Here I would look for targets of 4,600. Then buy on CDSL if it starts getting past 1230, 1231. It's just closed about 4-5 points below that. So about 1231, buy with a stop at 1209 for targets of 1275. And one sell call, that's Aurobindo Pharma. Looks to be some kind of a profit booking pullback going on over here. So in the short term, sell with a stop at 1485 for targets of 1420.
All right. Sudarshan, what stocks would you go with?
I have a mix. I have Eternal as a buy, a much better chart than it was earlier. Buy with a stop under 245. NMDC is a buying opportunity. Again, a decent swing and position trading chart. Buy with a stop under 90. MCX is a short with a stop above 33.80, and Nykaa is a short above 270. The short selling is only because they are looking at a correction. So the correction will end sometime. Be swift if you short to take profits.
All right, gentlemen, we'll come back to you for more calls at 9:10. For now, let's put the spotlight on the oil and gas space. Probal Sen, analyst at ICICI Securities, is now joining in. Probal, let's begin with your view on ONGC. What's the read?
I think the results, that just come out, the analyst meet is still, going to be at 11 o'clock. So, but on the headline, I think the increase in the OPEX was a bit of a negative surprise. Therefore, the results did come in a bit below our estimates, at least for the quarter. Having said that, I think the main thing to look at it really is, what happens going forward. They have recently expanded the technical service arrangement with BP to cover the entirety of the Western Offshore, which suggests that the results from the Mumbai offshore technical service arrangement are going, in line or ahead of what they were looking at, which is something that's definitely a positive from a sustainable production perspective. The Daman offshore project should ramp up steadily over the next year, and most remaining hiccups in terms of infrastructure or any other remaining issues with respect to the KG basin development seem to have been completed as per the management. So even that ramp up should actually start to show up in the overall production numbers. So while the production remains moderate or muted even for FY26, we are fairly optimistic about production prospects for 27 and 28. The second thing, of course, is that as of now, realizations, at least for Q1, do seem extremely, extremely strong. We have not really seen any measures by the government to, cap realizations in any way. And with the royalty changes also coming through, I think the earnings prospects for ONGC are something that will continue to get stronger. This was one quarter result. Year end, there could have been adjustments that could have been made in OPEX. There could have been higher exploration and depreciation costs and so on. So, I don't think one should read too much into the numbers for the quarter.
Prabal, where if oil stays high, they learn more. But in terms of producing more, that's where the government thrust and all this energy security talk, etc., comes through, right? So can we see a dramatic shift in some way that ONGC operates, which gets them to explore more, have more success, and that kind of thing? I mean, that's the question. How much they're able to produce. Price, of course, will move up and down.
I think those are the points that I was referring to, the kind of technical service arrangements that they've now done with BP on the Western Offshore, which is pretty much the largest producing area for ONGC, but also one of the oldest assets that they have, and has been seeing a fairly steady decline over the last 5 to 7 years. And what we understand from the management is that at least on the Mumbai offshore assets, the decline has already been stemmed to a certain extent with the initiatives that BP has taken. And if that extends to the entire Western Offshore region, then at least the overall decline rates for existing assets itself can actually see some improvement. That's number one. Number two, as I said, with the offshore assets of Daman and KG starting to ramp up this year, I think that is something that will also provide some incentive to production. With respect to what government is doing, I think the Samudra Manthan initiative that is there, I think Melinda spoke about it in some detail, with respect to sponsoring some of the deep water and ultra deep water wells. And in addition to that, the changes that have been done in the royalty regime, specifically for new exploration or, fields that have basically been awarded, under different bidding schemes, but which are brought aggressively back into production. There are now more incentives as far as royalty deferment and lower rates that the government is doing. So I think from a government and regulatory standpoint, the environment is being made much more enabling for upstream companies. Of course, it will depend on execution skills and the intent by the management. And I think that's something that will be a key monitorable going forward for the next 1 to 2 years.
So in, say, FY, what is oil production growth for ONGC? Like, what does it average, and what are you expecting? Are you expecting that number to move up?
As per our last published numbers, we were building in about 2 to 3% production growth on an annualized basis over both 27 and 28. As I said, we're going to have to sort of wait for whether there's any change in the official guidance in the call that's happening at 11 o'clock today. but that was our published numbers. So that is the kind of growth that we're building.
All this holds true for Oil India as well? I mean, the same kind of thesis?
I think Oil India, the numbers could actually be slightly better, primarily because, they do have assets that are capable of producing, specifically as far as natural gas is concerned. They do have assets that are capable of producing a bigger number for a very long time.
Okay. What about on oil marketing companies? We've had about 7.5 rupees of hikes so far. Do you think more is coming?
I don't know. I don't think that, one can speculate on whether more is coming. All I can tell you is that there is another 6 to 7 rupees of increase that is needed as of prices to basically get to gross margin break even. Having said that, these price increases that have happened from 15th to 25th, that alone has actually reduced the potential annualized losses by more than 1 trillion for petrol and diesel. So it is a significant move in terms of, sort of helping the OMCs manage the losses. Whether they will actually go ahead and do the increases to completely eliminate the losses, or maybe there could be a wait and watch, given that there are some signs and there are some reports that the conflict in the Gulf may be getting into some sort of a resolution, at least over the next couple of weeks. So, that's something that the OMCs and the government look at. I have no
idea. Got that. Just one quick bit, Prabal. Do you have? You don't look at Coal India, right? Or you have?
No. Coal India is looked at by Mohit Kumar, who's the power at.
I see. Fair enough. We'll leave it there. Prabal, thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. Well, let's just move on to I think the pre-open session has come to an end. So maybe just look at the Nifty, and it's down about 33 points. Tomorrow is a market holiday, so that's the other thing. If you are taking positions, so you got to account for that, act accordingly. So probably at the margin, it does take away from how much risk people want to carry overnight. In any case, I think a lot of people who are trading just want to go day to day, unless, of course, you have a positional view, which is also worked out sometimes. But, more often than not, headlines kind of stop you out as you begin the new session. Sudarshan and Mitesh are back with us with their 9-10 calls, hitting them a little earlier today. Sudarshan, what do you have?
It's Eternal. Buy Eternal with a stop under 245.
Eternal. And Mitesh, what about you?
I'll go with long on Canara Bank with a stop below 129.5 and a target of 140.
Canara Bank. Mitesh, IFB went up, he's not done anything, but was up a lot yesterday, and then, of course, ended 11% higher off the highs. But any thoughts here?
So, I'm not been tracking the stock, but, personally look at the charts, tell me that the stock peaked around levels of 1230 first in February 26 and then again in May 26, and yesterday hit a high of 1280. So I think around 1220, 1230, there's a supply pivot, but once it starts getting past that, the stock would really get into a strong uptrend.
Got that. Thanks very much, Mitesh and Sudarshan, for those trades and that perspective as well. 5 minutes to go for market open. The big question, the dollar rupee is open, by the way. We should put that up. And we'll just take a quick look at where we are starting. It's kind of flattish, nothing very much, 0.05% change in the dollar rupee. But it's a talk of the town, right? The BOP is going to be negative, big negative, and where all will it show up? So here's a mix, a set of opinion from some of the really top fixed income CIOs describing the current situation that we find ourselves in, because the BOP, the big negative, is showing up in rate transmission in a significant way, something that we've discussed quite a bit. And of course, here's some advice from practitioners in the fixed income market on what the RBI needs to do. Suyash Chaudhary of Bandhan and Amit Tripathi of Nippon. Listen in.
Where we are now, and not really from a credit deterioration standpoint, but the right pricing of credit, we are in essence in the midst of a funding shock, which is coming from a sustained period of balance of payment deficit. And so the country level lack of dollar funding is percolating into liability side funding, I would say, stresses in terms of availability and cost of capital across the board. And on the other side, you are seeing probably a once in a decadal, if not more shock from the commodity cycle suddenly flaring up. The lack of the India-US deal probably pressuring the SME, MSME sector. So not so much of the credits that we as mutual funds get exposed to, because most of what we are talking about may not be issuers in the market. But I was just caution, that things are different for different people now, and there is a generalized, need to right price. Because if you're the holder of capital, you are, basically the setter of the narrative right now.
While the balance sheets are good, we are today, as an economy, struggling to fund a 13% credit growth, which means that somewhere the market infrastructure is becoming an issue. This is a macro structure issue. And the second macro structure issue which we need to address is this complete breakdown in terms of transmission, at least as far as debt capital markets are concerned, vis-a-vis the policy rates. Today, banks are borrowing 3-month money at 225 basis points over repo. The last time that happened was in a crisis period. So somewhere I think we need to manage the macro level issues properly at this point in time, so as to ensure that the liquidity issue does not convert into a credit issue in the near term.
Average inflation forecasts have to invariably move up, and RBI is first and foremost an inflation targeter. They should start the rate hike cycle going, but at the same time ensure that they don't unanchor markets' rate expectations. So you don't need a fresh pressure point coming from mixed commentary from the RBI. So you start the rate hike cycle going just to continue to be credible as a conventional inflation targeter. But it won't solve much for the time being. What you could potentially hope for is a benign confluence of events. And I am not operating via perfect wisdom. I'm sure there's a big piece I'm missing here. But what we can think as a benign confluence of events is some sort of a dollar bond strategy to whatever extent jumpstart it with a $30-40 billion flow. The cessation of war that takes commodities, so let's say oil back to 85-90. And then at some juncture, if the shock to the US economy, because that's also a K-shaped economy, starts to show in their labor market and Fed rate expectations were to turn again, then you could potentially get a window where dollar depreciates. In 2025, dollar depreciated, we didn't benefit. A lot of other EMs did. But hopefully this time around, because we are cheap enough, that could potentially show with us. And so you need that jump start to happen, and from there you can build that narrative.
Okay, a bunch of sort of interesting opinion coming through. As they say, fixed income markets sends things first up in terms of, and of course, equities perhaps a little later. Typically, bond markets do sense stresses in the system, smell them from far away. So advice from some top fixed income managers. We've got market open. It's absolutely flat, so not very much at all. Almost unchanged, 23,900 and 55,90 on the Nifty and the Nifty Bank. Sensex is also absolutely flat, not changed. The small cap index is up a quarter. The mid cap index, I think, is also starting maybe slightly higher. Yeah, 0.16, but there are small changes. 900 up, 500 lower. That's the advanced decline out of the gates. We will see how things settle in about 30-40 minutes. The Nifty heat map will give you a quick sense of how the 50 stocks are opening. You've got Hindalco, Sun, Eternal, NTPC, Tata Consumer, which are coming up with the top gains. On the other side, coal, ONGC and ITC are starting in the negative. It's about, 30-31 stocks in the green and about 19 names which are down in the red. Rima.
Well, Coal India is the big loser today on expected line. 6% lower for Coal India at open 431. The floor price for the 1% offer for sale is 412. So currently it's trading about 20 rupees higher than that offer for sale. ONGC is the other big loser with the fall today. It's dropped below the 50-day moving average. Numbers disappointing. Stock has fallen nearly 3%. Then you've got cuts in ITC, HDFC Banks. These two heavyweights are dragging the Nifty by nearly 2%. Infosys too has opened up on the flatter side, but with a negative bias. On the way up then, you've got strength in commodity names. So Hindalco, JSW Steel up and about. Pharma names like Dr. Reddy's Cipla seeing buying. It's a mixed picture across banks. So you've got an HDFC Bank in the red, but an Axis Bank is higher in trade. Eternal is seeing buying, and that's a stock which has moved up 4.5% this week itself. So third consecutive day of gains for that. And Adani Ports too, hitting fresh 52-week highs with the up move. Ultratech Cement, Bajaj Finance, Jio Financial, Tata Consumer are some of the other names with gains of over 0.5%. But very, very quiet. But good to see the mid-caps outperforming today, up nearly 0.5%.
Well, that's right, Rima. That's what I said at the beginning as well of the series. We could be in a bit of a range on the headline index, but going by the stock futures, both FIs as well as clients, they're aggressively net long. So stock-specific action should continue. A few stocks, though, are having bombastic moves. Let's pull a few of them up. Finolex Industries, stock up 10% in reaction to its numbers. Massive move is what we're seeing out there. PNG, normally a low liquidity stock, well, that's bursting away. That's up close to around 8.5%. So big move is what we're seeing out there. Carrado India, that stock is up close to around 7%. Big move is what we're seeing out there as well. JK Tyre, stock is bursting away, up 6.5% as we speak. I think Delta Corp as well is opening up with a gain of close to around 5%. I think there is a hearing that is scheduled with regard to that on that gaming case. So I guess that's why the stock has moved up. Remember, it's a fourth of what it was at its peak. And various other names that are doing quite well. Jindal Worldwide, another stock that's up and about in today's trading session. I think they're all reacting to their numbers. Even Gandhar Oil, I recall the stock seeing a bit of a spurt of late on very, very large volumes. And that one has moved up yet again. So pull up that stock. Gandhar is up close to around 5%. If I pull up the last 1 month chart, you'll see that the stock has rallied close to around 20% approximately. And Red Tape Limited, the street is buzzing with excitement that something's going to give out there. Well, that one's up close to 3.5%. Yesterday it was up more than 10%. I recall halfway through the trading session, it did spike up. And Nalco holding with gains of around 2%. This aluminium cycle is looking very, very good. I'll tell you what, Mr. Agarwal was sounding extremely optimistic. He'll want to list Vedanta Aluminium as soon as possible. He says in the next 1 month or so, the sooner he does it, the better, because global aluminium prices have spiked up. Vedanta Limited, that's a listed entity, that holds stake only in Hindustan Zinc. Otherwise, doesn't have much relation to Vedanta Aluminium itself. But that one as well, holding up and about. And as we did that market check, the market that was expected to open up with a cut of around 50 points, it opened up with a cut, but after yesterday's expiry-related fall of 100 points and today's 50-point downtake, that's got lapped into, the markets have moved into the green.
All right. It's 23,930 odd on the Nifty at this point in time, and the Nifty Bank will come up quickly, and we'll just look at where the indices are at. So this is flat right now, holding pattern, not very much up or down, but individual names, of course, there's been plenty of action. So no doubt of that. Deepika Mundra is with us. She is Director of Equity Research India at M&G Investments. Deepika, good morning. Great to have you with us here. Appreciate your time. Prashant this side. Deepika, so I was reading some of what you've written, which is the fact that while there's been so much hand-wringing and anxiety about why India is missing out on this big global AI capex super cycle, and other markets are overtaking it, and I mean, in both in absolute and relative terms, India has underperformed, and that's just a fact. You are not disheartened. You are finding opportunities here in the, as you call it, picks and shovels. So just run us through, and let's dive straight into that topic. How are you doing it here in India? Which are those picks and shovels, and where are the opportunities?
Well, good morning and thanks for having me. The regional trade, of course, AI has been the most dominant factor. The playbook, in fact, Prashant, has been very well established, right? The market is focused on bottlenecks, and every bottleneck from GPUs to CPUs gets repriced. India, while we don't have any meaningful play on hardware, we're going to be one of the largest users of AI and AI compute, and for which we're likely to see the development of data centers. So as of now, we have just over 1 gigawatt of data centers operational. There is a pipeline of 5 to 10 gigawatt to come through in the next 5 to 10 years. This will require a lot of capex from, and particularly in the electrical equipment space. So this is what we call the picks and shovels. We prefer the shorter cycle plays here, being able to reprice commodities quite quickly. So you have electrical equipment, gensets, cables and wires. You have a whole bunch of plays that can play out on the data center story. What we do have to be mindful of is that the correlations, just like we've seen in the region, are very high in India as well. Almost all of these stocks are up more than 100% over the past 12 months. So we have to we are being conscious on valuation and thinking more bottoms up than just then from a top-down data center theme perspective.
And valuations here are, I mean, these are well-discovered stories, right? Even before this data center and the AI thing burst into the scene, I mean, these were some, I mean, growth was high, but so were valuations here.
Yes, I think they are well discovered. What we're seeing, though, is consistent build-up in order books. The focus, though, is going to remain on execution. And as we've seen in the recent past, the two key issues, which is commodity prices and supply chain bottlenecks, these are the two things mainly to solve for. And the companies that are being able to work around these better are likely to be the longer-term winners in this space.
Deepika, but these are all mid-caps, right? These genset, transformers, cables, etc. It's great for mutual funds in India for bottom-up ideas. But these aren't large enough companies to attract foreign capital back into India. What would be the total market capitalization, for instance, of India's differentiated AI play, if you want to put it like that?
Well, there are at least, I could say, 16 to 20 companies in this space. I would not be able to tell you the total market cap offhand, but it is fairly substantial. I mean, we're looking at companies easily within the $10 billion plus market cap range in each of these names. So it is fairly substantial. I think there is enough liquidity as well. What we are being more conscious of course, like I mentioned earlier, is on the valuation front. I think we're finding enough liquidity in these names.
So if these are structural plays and it's going to play out, say, to 2030. Now, this argument has been made for Micron globally. Initially, it was seen as a cyclical commodity play, but now it's seen as a structural play. And therefore, you need to relook at the kind of valuation multiple. Should the same logic be applied to these companies, these 16, 20 companies? And yes, they're already trading at higher valuation multiples than they were in the prior cycles. But should one be willing to pay higher because there is growth visibility? I mean, you know, how do you wrap yourself around the valuation argument for these companies when there is growth?
Right. So see, we want to be able to reflect the AI and the industrials theme overall in the portfolio. At the same time, we don't want to run a risk of this being the dominant driver of returns. So I think it would be a mistake not to be present at all, but be more mindful of what we are doing within these themes, which is why I mentioned shorter cycle, ability to pass on commodity costs, and not single product companies. So I think what we're looking for is companies with much wider portfolios rather than being single product, where, let's say, if the capacity build-up is there and the cycle peaks, then you're left with idle capacity 2 to 3 years down the line. So slightly more, and I think we have some of these names available in India.
You've also added upstream oil and gas companies. Do you want to tell us a little bit more about that?
So since the Iran conflict broke out, we have had to rebalance the portfolio to some extent, while some of our calls have been very medium term in nature. So for instance, we have been underweight IT services for the last 2 years. We have been underweight on consumer staples for the last 2 years, mainly on valuation and low growth. We have taken some tactical measures to rebalance the portfolio post the conflict. So for instance, we are short or rather underweight certain names, like for instance, in the airline space, we have reduced our holdings considerably and at the same time rebalanced to reflect that versus higher exposure to commodities.
So that's a tactical play, the upstream. And so the increased weightage is a tactical play just till the Iran conflict is ongoing? Or do you think we are going to see policy measures which help increase production?
Well, that is clearly what has been in the headlines over the last few days, right? The focus on increasing production. Also, the current oil price is not reflected in these names. If we look at oil futures, not just the current spot prices, they too have moved higher quite considerably.
Yeah. So, I mean, M&G invests globally, right? Deepika?
Yes, most definitely.
Yeah. So where is India relative? I mean, so, you know, there's this, the weight is now, I think Taiwan is in MSCI EM, for example. I don't know which benchmark you guys use, but, you know, we were, I think, 17, 18%. Now we've fallen quite a bit. I mean, just a function of how market caps have moved. But what is your sense? How are you placed the market itself?
Right. So we have different strategies, and then different strategies will end up having different benchmarks. From an India perspective, we remain fully deployed, so we have no cash in our India portfolios. But our name count, for instance, is much lower than what it used to be. So we are a lot more concentrated in our holdings today than we were, let's say, in 2024. So from that perspective, we remain constructive on India. It's not that we are not, but our name count is much lower than what it used to be.
And so how many names are we talking about, Deepika?
So on average, we would have about 50 to 60 names in the portfolio.
I see. And what's the AUM here in India?
Sorry, I will not be able to disclose all those details. That you'll have to speak to my comms team for that. But
sure. No problem.
Yeah, a lot of that is public information on the MNG side.
Okay, all right. Hi, Deepika. Good to see you in. This is Nigel on this side. The other burning debate is whether or not it's time for the FIs to come back into India. A couple of points out, yeah? India's weight on the emerging markets, well, it went from 8% in 2020 all the way to 21% in 2024, and we're back down to around 11-12% or thereabouts. So, the flows have been actually eluded us. There is this argument that valuations weren't very, very cheap. In fact, expensive, but maybe a little bit too expensive in comparison to us peers. Give and take everything, given that we're hopefully at the end of this war, hopefully crude oil prices don't spike up from here on, and earnings momentum should pick up in India. Do you think there's a good argument that FI flows could return back to India? Their selling actually has reduced in the last few months.
Well, I think you made the argument for me, so I needn't add much more. But I'd just draw back to the where we started the conversation, right? AI as a trade is been very dominant. The correlation across markets is very high, and so is the concentration. So while we're aware of the very long-term opportunity of the AI beneficiaries as well as the enablers, we think that there is space for India under the sun as well. And like you rightly pointed out, the earnings have been reasonably good. The main problem that I think that we need to solve for is the currency.
And do you have strong views on what perhaps is needed? We had a bunch of fixed income CIOs yesterday, and there was varied opinion. But any thoughts there?
Well, I am no fixed income expert, but stabilization in the rupee would be much helpful for FII flows to come back to India.
Yeah, no, that's a given. But okay, so but yeah, fair enough. Deepika, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. So that's Deepika with the MNG Investments with some perspective. Well, I think markets are holding, but just about 15 odd points lower. So it's been flat. The indicative open was kind of flattish, and we are not very different at this point in time. Let's just look at where else is... Coal India perhaps comes up, but these are all news related here and there with that offer for sale.
Good recovery from the lows, actually.
Down 6 now, down about 4% or so from the lows.
Yeah, I think the market actually was a little bit net short on that one, waiting for this to take place. Remember, the flow price is 412 rupees, but actually what the price at which you get demand could be much higher than that. It could be much higher than 412 rupees, and there are various arguments that work in favor of Coal India. In a bit, we'll tell you why the government could probably have found an opportune time to go ahead and do this take. We'll get to that in just a bit from now.
Yeah. Any other stocks, guys? Moving around, and we'll have Vinny in just a bit to talk about.
I think the aluminium stocks, the listed ones, they are taking heart from that. And I'm sure you guys remember, and I'm sure, most of our viewers as well, they keep writing to us. But in December, I think December 5th or 7th of 2025, we had put out this piece about why aluminium will be in a bit of a deficit for this year. And that's why it could be the commodity to track in 2026. I'm sure that, most of us will remember that. And this Middle East crisis has put that gap actually a little bit wider. And that's why you're seeing aluminium prices have gone one way. The last 6 months, these stocks have gone, up in a drastic manner. Nalco, remember, they don't get the benefit of high alumina prices, but yet the stock is rallying. You have Hindalco that's seen a big rally as well. 60% rally in the last 6 months or so. Big move, and Vedanta Aluminium is waiting to get listed. Earlier, people were expecting 420, 430, 440 rupees or thereabouts. Going by the current prices of aluminium, when Vedanta Aluminium, not Vedanta Limited, when Vedanta Aluminium gets listed, it could see a big spurt up. Vedanta Limited has nothing to do with Vedanta Aluminium as of now. It's just the holding company of Hindustan Zinc.
All right, that's on the aluminium plays. Carraro India is a big mover. Sudarshan was telling us about the strong numbers, 25% revenue growth, 48% profit growth, and that stock is surging. Along with that, JK Tyre, and you also have strength coming through in landmark cars. Again, not a number we've spoken about, but the profit here has gone up to 15 crore versus 1.4 crore, and stock is seeing buying. Along with that, Gandhar Oil. Again, the stock here has, the profits have gone up to 40 crore versus 12 crores. So some of these stocks are making big moves. Along with that, you've got Transrail Lighting. So let's put the spotlight on that. Vinny joins in with more.
Hi, so Transrail Lighting, they've reported a weak set of numbers, right? Revenue has seen a decline of around 4.25% on a year-on-year basis versus the previous quarters, which they managed to do well. But do not forget, Q4 FY25 was a very high base for them. Now, margins also have fallen for the company, 90 basis point decline that we've seen coming in. For the full year FY26, the management has given a guidance of around a 30% revenue growth that they would manage to do, 29 to 30%, which they managed to do for the full year. But all in all, there was a miss that came in for Q4 FY26, revenue decline that came in after a couple of quarters of growth, and that is why the street is not happy with that. They have an order inflow of around 520 crores for FY26, of which 37% accounts to international. They do have some exposure to the GCC region as well as the West Asia side as well. So that will be something important to watch out for if there was any major impact that came in because of that as well.
All right, thank you very much for that. Let's move on now to our next guest. It's Aren Captain. I hope I'm pronouncing it right. He's the Global Head of Economics and Strategy Research at UBS. He joins us from the UBS Asian Investment Conference 2026. Thank you very much for joining in. How was day one, Aren? What were the key takeaways? What were your learnings from it? And what are you looking forward to today? I think you're on mute. If you could hear me, I request you to kindly unmute. All right, seems to be a little bit of an audio glitch. So here's what we'll do. We'll get into a short break. We'll come back and reconnect with him. Welcome back. We managed to connect with Aren Captain, Global Head of Economic Strategy Research at UBS. He joins in from Hong Kong from their Asian Investment Conference. Aren, great to have you. Looks like we've connected. We were just trying to understand how was day one. And before going into the conference, you had compiled some of the difficult questions that you received from investors. For example, can the incoming Fed chief deliver on rate cuts? What's more important to the global economy? AI energy? Is AI inflationary or disinflationary? So tell us, have you got the answers to all these questions? What's the key takeaway?
So, and actually, that's the focus of the conference. So there's a heavy dose of AI and why are markets going up when we have all these energy risks. And then, of course, there's the themes around is China reflating and what's the Fed going to do. So we answered all the questions in a note yesterday. So we're discussing the same thing here today at the conference.
Do you want to tell us quickly your views?
So I think the remarkable thing is that so 60% of the index performance year to date in equity markets is driven by tech. And so on the equity side, you've seen that really neutralize all the energy related weakness. But that's even true economically. So if you look at the countries that are part of the AI supply chain, it's over 50% of GDP. And they have basically had, in terms of trade gain, that is significantly larger than the oil price increase. So memory prices are up about 8 times as much as oil prices. And so that seems to be neutralizing, at least at these oil levels, I think, the negative impact. And hence, we've seen actually very little movement in the global hard data. We've seen a lot of weakness in the surveys, not a lot of weakness yet in the hard data. So that's basically good news and a little bit unexpected.
Korea and Taiwan, I mean, just to, I think the AI export boom is so strong. I mean, I think they're probably wondering, what is 100, right? Give us 120. I mean, it's just crazy, right? The surplus as a percentage of GDP is 10-15% now for these countries, Aaron.
Yeah, so if you look at Korea, I mean, it depends what you annualize the last month, but it looks like it could be running at something like 22% of GDP annualized. Coming into the year, we thought it would be 6, so now it's partly a big price effect, right? So memory prices are up about 455%, so that has a big impact, but it's also the volume. And I think really the way to think about it is if the US hyperscaler companies are going to basically invest $1 trillion, and you put that money into an economy that is 16 times smaller in the case of Korea, or 30 times smaller in the case of Taiwan, you're going to get enormous impacts, I think, on those economies and on the equity market. Like just for Taiwan, for example, we think you've got something like a 10 percentage point of GDP contribution just from the net exports, right? And that's basically the flip side of all the spending that's happening in the U.S.
This thing, right? There are only 3 stocks in Asia right now, maybe 4. Just exaggerating to make a point, right? There's Samsung, there's SK Hynix, there is Micron, there is TSMC. But is it getting? So Taiwan, for example, yesterday there were these headlines that it's overtaken India in terms of market cap, but their market cap is now 5 times its GDP. How does this play out in your opinion? When does it become too much?
Well, so right now it looks like the supply of chips is running way below the demand for chips. And so, I mean, what that's actually doing, I think, it's hopefully creating a smoother path for Taiwan. If they basically were to ramp up the production to meet, I think, what the U.S. is asking for, then you basically get a boom-bust cycle where, the memory prices would ultimately come very, very sharply. And then all the positive things you see happening now would turn into basically negative drag. And so partly by keeping the market undersupplied or basically the chips and the memory not being able to ramp up so rapidly, this will probably extend, I think, the sort of the tech cycle or the AI cycle. Now, eventually, I think there's a lot of uncertainty about, where this CapEx cycle is going and how long it has to run. But certainly, I think for the next year and a half, it looks like we're just going to get more of the same. And as you say, it is very concentrated here in just a few economies. It's basically Korea, Taiwan, and maybe Malaysia, but beyond that, and China, but beyond that, not too much else.
Arend, hi, good to see you in. Hopefully we get the visual back. I wanted your view on India. India's market capitalization, as a percentage of the globe has come down to around 3%. That's the level from where, because of the recent underperformance, from 4% it's come to around 3%. Even if you look at our weightage on the MSCI Emerging Market Index, that as well has come down. Post this period of underperformance, how do you see India fit into the scheme of things, in your scheme of things, and where would it come in the pecking order?
Yeah, so I think there's 2 perception problems. So one is obviously India, like many other countries in Asia, is very sensitive here to this energy disruption, right? So there's an immediate sort of widening of the current account deficit, creates currency vulnerability. And once the currency is perceived to be vulnerable, it becomes very hard to invest in local currency assets because you're basically facing that currency risk. That's problem number 1. Problem number 2 is that it is not perceived to be part of the AI play that applies to a lot of the rest of Asia. And right now, that is really the predominant thing that I think investors want to invest in. And then the third thing is that while the currency has cheapened somewhat, it's still not really perceived to be cheap. The equity market, while underperforming, is still not perceived to be cheap either. And so that, I think, currently creates sort of a complicated set of circumstances where, the route of least resistance is to buy the things that have momentum, which is basically the AI plays outside of India. Now, that could very quickly reverse. I mean, if there's a resolution particularly on the energy side, if there's a resolution in the Middle East, then I think we'll get a knee-jerk reaction that the most vulnerable countries to those higher energy prices will come rallying back. I think to take some pressure off the currency will then also make it easier to start thinking again about retaking that local currency exposure and equity. But the structural headwind, I think, is that India is not perceived to be a play on AI.
But it's still growing at about 7%. We've got a demographic dividend, and it's no longer very expensive compared to its own relative standards. So if the war comes to an end and that headwind is out of the way, do you see interest in India? I mean, does India even come up in the conversations that you're having in the conference right now?
It does come up because I think there's a desire not to have all the eggs in one basket, right? I think a lot of the, basically it's really, there are 4 countries, or roughly, it's China, Korea, Taiwan, and US that are sort of big AI plays. I think right now that is the sort of the route of least resistance where investors feel comfortable. But, having that level of concentration and risk ultimately is not very desirable. So I think there is a lot of clients are actually praying that, this energy crisis goes away so that they can start to think more idiosyncratically about what are the other things, that you could invest in that are not sensitive to some sort of global, beta effect on energy price. And then I think people will try to come back to India and some of the large, it is a large country. So I think there is a desire to start to look at those things again. Right now, though, the market is just super one-dimensional, just focused really on energy risk and AI. And I think we really need, the energy risk to go away, take the currency pressure off. And then we have a dollar INR forecast of, 96 by the end of the fiscal year. If that's if we stay in those type of ranges and the market shows that things are sort of stable, then I do think investors will come back.
A fair point there. So, Aaron, this is a question which I think I'm sure gets discussed. What you think something will pop this entire big AI thing trade? I'm not saying it's real and here to stay, etc. But maybe something changes technology-wise, for example, all this reporting that it's become too expensive. AI budgets are being blown up in 3 months. What was supposed to last for a year? This is an industry built for scarcity, right? So when this kind of a thing happens, then if suddenly you start to realize, well, is that what's going to be the tell that this is now becoming too large and problematic?
So I think the risk here is, I think this is a multi-year CapEx cycle. Clearly, there are 3 companies basically funding it, right? It's Meta, Google, and Amazon that are driving 90% of the CapEx. They have exhausted their cash flow largely. So we're now projecting, I think, $250 billion in borrowing for these tech companies. So that's becoming a constraint. There's to some extent a funding constraint to sort of sustaining this cycle. And I think, the funding is there as long as there's a perception that the earnings are going to be there. And so I think the risk is ultimately that there's an entrant into, particularly from China, an entrant into the sector that is able to produce at much lower cost, much lower energy costs. And then I think people might have a rethink about, what is sustainability of these sky-high profit margins that these companies have. And then you could see, a repricing of that portion of the tech sector. But that's just on the hyperscaler CapEx side. And of course, the other part of it is that now there's a diffusion of the technology into basically the rest of the equity market. And there, I think it's just much more unpredictable where things are going. So while sort of tech more broadly defined is now, lifting all boats, I think actually investors have very little clarity about who the winners and losers are going to be. So right now, it's still, I think it is sort of very focused on on basically, NVIDIA and the hyperscalers, and the CapEx cycle probably has another couple of years to run. I think the valuations based on the current earnings, I think are defendable. The question is whether those earnings are correct or not, right? And I think we'll have to wait and see. I'm not the equity analyst in those companies, so I won't comment. But I think there's sort of a general level of nervousness out there about that.
As an economist, is AI inflationary or deflationary based on what you've seen right now? And what's your own view on what the Fed is going to do? It's, his predecessor faced a lot of political pressure.
Yeah. So it's inflationary right now. So we have an estimate in the note you mentioned earlier that in the US, if you look at PCE prices, we have about 40 basis points of AI effect, and that's coming through various channels. So one is just the memory channels. So as I mentioned, memory prices are up a lot, but also through the stock market. So when you have an enormous increase in the stock market, you get a financial services effect that's worth about 20 basis points. So in the near term, actually, AI is inflationary, right? So that's for this year. you already have tariffs, you have the energy, and then you have 40 basis points of an AI add-on to the PCE data, not so much the CPI data. Now, in the medium long run, I think it's disinflationary, right? So if it's associated with a lot of labor shedding, then clearly that would be disinflationary. Even if there's no labor shedding and productivity goes up, then that's likely also disinflationary. But that still has to happen. I think the productivity numbers that we're currently seeing, in my mind, aren't really AI productivity. They're have much more to do with a shift away from labor-intensive production to capital-intensive production. So you generate a lot of GDP with a couple of companies doing a lot of capex. You don't hire anybody. That looks like productivity, but it's not really productivity in the sense of us knowing what to do with the technology and becoming more productive. I think that's still to come. So what it is doing, though, and that's in some sense becoming disinflationary, I think the AI fear is having a chilling effect on labor markets. So if you look at the Challenger data in the US, a quarter of all the layoffs are now said to be attributed to AI. If you look at wage growth, that is already running below what our models would have predicted. So I think there's already sort of a perception that the bargaining power that people have and labor has is going to go down as the technology gets rolled out. Now, we're not able to measure that yet, but I think that's something for next year and the year beyond, where I do think we're going to go from inflationary to potentially disinflationary. And that, I think, is the argument that Kevin Warsh is going to try to make, right? That this is sort of a 1990s Greenspan-like sort of analogy where you basically want to accelerate the destination point to get to that productivity, because then it solves all the problems. You basically solve your inflation problem. Eventually, of course, then the notion is you solve your employment problem as well. And why not cut to get there more quickly? I think right now that's not possible. I think the data is just not giving him the cover to sort of make that argument. And so I think that is much more next year's story than this year's story.
All right. We'll leave it there. Thank you very much for joining us. Fascinating conversation. And glad you could sort of join us today, and hope we're able to chat more outside of the conference as well. Thank you for being here. So that is perspective coming in through the UBS conference there. Well, I think markets are down 24, so not very much happening. Let's get to EID Parry. Nigel.
Well, that's right. That's the next management on the show. The sugar and biofuel division saw better profitability due to better realization and cost optimization measures. Mr. Muthu Murugapan, the CEO and whole-time director of EID Parry, joins us on the show. Hi, sir. Good morning. Good to see you. And as always, what kind of growth guidance are you looking at for this year? I'm looking at last year. I think for the company on the whole, it was a 20% growth with margins improving around 40 to 50 basis points. How do you see FY27 pan out?
Hi, Nigel. Good morning, and thank you for having me on the show. So I think FY27 looks a challenging year. I think we had a good crush last year, and as you mentioned, good realization as well in the sugar and biofuels business. However, looking ahead, I think there are some challenges that lie on the road ahead. I think from a sugar perspective, we are seeing prices being largely range-bound and not moving up too much. We're also seeing a very likely deficit monsoon. This could impact the crop yield as well, and this could impact the cost line going forward. Beyond this, there are pressures on input costs, given the West Asia crisis, particularly on processed chemicals, fuel costs, as well as other material costs. So there could be some stress, going into FY27.
Okay, got it. All right, some stress going ahead, but you wouldn't want to put a guidance to it? High single digit, mid-teens, something on those lines?
No, Nigel, so we don't really give guidance. I think we'll have to really hunker down and watch the situation. There are a lot of moving parts currently.
Let's focus on ethanol sales then. What was the total volume that you did in the past year, and this year, what is it likely to be, and how are input costs panning out there?
Sure. The distillery segment has also been challenging in F26. Our alcohol volumes are just over 16 crore liters, much the same as F25. As you know, on the ethanol side, there is a significant amount of overcapacity. We're at a 20% blend right now that needs about 1,300 crore liters of capacity. The installed capacity in India is close to 2,400 crore liters. So allocations have not sort of enabled us to utilize our capacity. Given the overcapacity situation, we've also seen ENA prices coming down. That's our other product line in the distillery segment. And in this sense, margins have dipped. We're down to EBITDA margins of 4% on this business It was 8% in F25, and perhaps prior to that, it was closer to 20%. So we do see this as a challenge. Ethanol prices also haven't gone up for 3 years. So here again, I think we have to really manage for cost and efficiency going forward.
What is the peak capacity? You said you did 11 crore liters last year, right? What kind of capacity?
In terms of our total alcohol volumes in F26, we've done about 16 odd crore liters.
Yes.
We did much the same last year. Our capacity is closer to 19 crore liters.
19 crore liters. Okay.
Mr. Murugappan, Rima here. Can you talk to us about your decision to exit Parry Sugars in the refinery business? Will the total hit be closer to 1,000 crore rupees? Because there's an impairment loss of 400 and the provision towards a financial guarantee obligation of nearly 600 crore rupees. What would be the amount that you will be able to recover, maybe on account of land, plant, equipment sales, etc.?
So, Rima, this has been a challenging business for EID Parry for a better part of the last 2 decades. So, I think a call was taken to exit really because of operational unviability, high leverage and also lower spreads. Yes, the impairment, I think, as you've articulated, is about 400 odd crores on account of the investment in the asset, 591 crores on account of the liabilities. Now we are working to see what best we can recover. The recovery would largely be from the infrastructure that's available at the plant and the sale of the infrastructure. And I think this process has started.
Any range, how much you will be able to recover? Because it's a sizable amount that's getting hit on account of the obligations and impairment, as we said, nearly 1,000 crore.
Yeah, so Rima, it'll be nowhere near the impairment levels. I wouldn't like to comment on the exact number. I think those are deliberations which are ongoing right now. But this, I think, the exit of the refinery was really part of a meticulous plan which we put together.
Even the consumer business has had a tough FY26. Revenues of 600 crore versus 884 crore. At the EBIT level, segment EBIT level, it's been a little worse off than what it was in the prior year. What's the plan here? Are you seeing any signs of a recovery, and what led to the weakness?
So, Rima, the consumer business was really a purposeful recalibration of the business model. I think we looked at the market credit piece to start with. We also looked at the product portfolio. We made some changes there, as well as on our pricing strategy. So I think all of this has led to the contraction of the business. I think going forward, we really want to put a stronger business model in place, a business model with more value-added products and a model with more products of margin accretive products going forward. So that's the plan. I think you will see that pan out in F27. We really want to put a stronger model in place to enable growth in this business.
Final question, sir, before we let you go. What's the plan with Coromandel, the shares that EID has? Possible that investors could look at you paring down stake a little bit. You still have more than 56%. So some kind of give back in a challenging year, some inflow into the business will be good.
So, Nigel, no such discussion at this point in time.
Sometime during the fiscal, would that be a targeted holding that you have in the company? You could still bring it down to 51% at some point of time and still hold maximum stake.
No, as I said, Nigel, no real discussion at this point in time on the core stake.
We appreciate you joining in, sir. All the very best for the coming fiscal. As you said, some challenges, but you appear prepared with some of those verticals and the business strategy as well. We'll chat up during the course of the year.
Thank you.
All right. Thanks very much for that. So that is EID Parry in focus there. No change with regards to markets. We're still down about 20 odd points or so. Acres is the next company on our radar. It's a fairly recent listing still. And they are in the hot aerospace segment. And of course, consumer electronics as well. Now, revenues for the fourth quarter went up, but margins, absolute EBITDA and EBITDA margins contracted. For the full year, numbers look pretty strong. So we'll, of course, map out what happened in Q4, but of course, get a sense of F527 as well. Aravind Meligari is Executive Chairman and CEO at Acres. Mr. Meligari, good morning. Great to have you back on the program. Thanks for joining in. The fourth quarter contraction is, as I understand it, due to the full ramp-up of the consumer electronics business. And so let's just start there. What happened and by when will this business turn around, break even and start to scale?
Yeah.
If you really look at it, Q3 is when we had first commercial production, and we had a capitalization stopped, and Q4 complete. All the costs showed up in the Q4 for us in the consumer electronics side, and that basically led to the actual full capex in the books showing up, and also the operation cost showing up. And utilization has moved up a little bit, but not to the level where fully can be absorbed. So that's what has happened. And so we see, we have guided towards Q4 27 to be the EBITDA break even for the consumer business, whereas our aerospace continues to, thrive well and continue to grow and continue to improve the margins what we have seen.
So, Mr. Meligari, by when will the consumer electronics business break even?
Q4 27 is what we have guided towards EBITDA break even.
EBITDA break even by Q4 of this year, this financial year.
Yes.
Got that. Now, what should we expect for the full year, FY27? You saw a 43% EBITDA jump in 26 over 25. What can we expect?
We're expecting to double our EBITDA in the coming year, FY27, and 100% growth.
Oh, wow. So, you'd go to what, 300 crores?
Yeah.
300 crores in EBITDA this year. And what about margins, sir?
Yeah, I mean, aerospace will continue to maintain about 20% operating EBITDA margin. And as I said, consumer will get towards the tail end, a Q4 level, EBITDA break even.
Okay.
That's what we'll see.
Yeah, sorry, at a net level, if you can give us a sense?
At a net level, we are, in terms of you're talking PAT level.
Yeah, PAT level.
Pretty much we should be able to, we will take a PAT positive only in the H1 of 28 at this stage where we are guiding.
I see. So do you have a sense of where the net number will look like for full year FY28 then? I mean, the market's already pricing stocks on FY28 earnings. So might as well ask you that.
I cannot guide at this stage, So because there are a lot of moving elements, just to give you, we are adding additional capex on the consumer side this year, close to 500 crore. And that will, when that comes on full online, and that also has a factor in there. That's the reason what we are guiding as a percentage. We may not be able to position right now, but as a overall, we have an internal target to get to the, PAT positive in the H1 of 28.
And the split between the businesses by that time, H1 28 will be on an EBITDA level, will be aerospace and consumer electronics will be what, sir?
The revenue basis, we are, currently we are, our goal is to get towards more like a 20, currently we'll end up at 22% level of aerospace at that point in time.
Sorry, that's the revenue.
Consumer side.
Yeah. Revenue makes 22 consumer electronics, basically. Is by FY28.
27 end, right? That's what it is.
Okay.
And currently it's about 15%. So it goes up from 15 to... So just to quickly recap all the guidance that you've shared with us, on a consolidated basis, EBITDA doubles in FY27. For the consumer business, EBITDA break even by Q4 FY27, PAT positive by H1 FY28. And the top line growth will be?
Top line growth, where aerospace, we're planning for 25 to 30% for the FY27. And, and consumer, we're, basically going between 125 to 150% on the consumer side, consumer side overall. And overall, we'll double 50% growth year on year on the revenue.
So on the consumer side, the focus this year is going to be on EBITDA break even. But thereafter that, because there is capacity which you're adding, there is capex that you've planned. What is the trajectory of the consumer business as you see it in terms of the EBITDA? So margins for aerospace are high, above 30%. How will the consumer margins look like? What is your long-term plan?
Our long-term consumer margins are going to be about 20% EBITDA. That's what I have always, communicated, and we expect it to happen that way. It's a function of utilization, Rima, and its utilization continues to improve. As the utilization improves, and then we'll pretty much get there.
Okay. I believe your operating cash flow was negative last year, and you've got a very large capex that you've lined up of nearly 660 crore in FY27. How are you planning to fund that? What is the net debt level?
So currently net debt is about 100 crore right now, and we'll end up about net debt about 800 crore by end of the year, including the working capital increase and the capex what we'll be doing. And we feel good about where we are with that stage.
Sharp increase in your net debt, sir. Would you at some point look at equity fundraise? Or are you comfortable with the net debt jumping 7x, 8x?
At this stage, we feel comfortable. And if we need, from organic side of it, we are fine. If there is anything else needs to happen, we'll look at it. We're open.
And what's the cost of this debt, Mr. Meleguri?
Somewhere around 9% level. Could be, anywhere between 6 to 9%, depending on whether it's a PCFC versus, dollar borrowing versus rupee borrowing.
So average is 9, you're saying 9%?
So we take it internally 9% as borrowing cost.
So that's about 100 crores a year in terms of interest payments.
Yeah.
Yeah. So, but you obviously don't want to stay here, right? At these levels of...
Look, manufacturing cannot be grown without, if you're growing at a certain rate, 10, 20%, you can do through internal accrual. You need debt to come in. And that's the reason we look at EBITDA as the growth measure at this stage of high growth stage of the business. So we need to leverage the debt to scale this business. And this opportunity we have as India, as a country, we have two unique situations: one, aerospace growth, and also same time consumer electronics, manufacturing moving into the country, and we're in a sweet spot on both the verticals. So we, ideally given, we can get all the assets getting sweated, and then we invest further. All that can happen, but customers won't wait.
Yeah, no, I completely agree. And of course, I mean, we at CNBC have visited the facility, etc., and what you've built. So it's quite fantastic. Let me just push just one last number. You said EBITDA will grow 100% in 27 over 26. 28 over 27. You have visibility. I mean, these are orders which are, unless somebody drops off, you have a solid order book, and you know how much you can execute. So in 28 over 27, what should we expect? From 300, what will EBITDA go to?
Yeah, keep looking at a capex level, what we are doing this year, they're all coming on board, and we should be able to see similar level of growth in FY28.
So 100% EBITDA growth in 27, 100% EBITDA growth in FY28.
I didn't say that in that range, I said.
Okay, in that range. Okay. All right. Well, we wish you all the best of luck. We need, aerospace champions out of the country, and we wish you the best of luck. Thank you very much for joining us.
Thank you.
Okay, well, I think the markets now, it's like a traffic light. 5 points up, 5 points down. 23,922 is where we're at. The F&O data in terms of what's happening on the BSE. Mangalam is here with exactly that. Mangalam, take it away.
Well, it's been fairly volatile ever since the market gave up from highs yesterday ahead of the monthly expiry on the NSE. The BSE expiry is today, and ahead of that, the sensex has actually given up important levels as well. 76,000 is an important mark. So sticking around this would be extremely crucial. Tomorrow is a holiday, which is why, remember, all the BSE options expire today on Wednesday. That's the 27th. 76,173 is the 20-day moving average, and 76,36, where the Sensex right now is the 50-day moving average. So the next 100 points, 200 points on the Sensex, extremely crucial when it comes to resistances, and those are marks which are important to cross. Were that to not happen, then 76,000 as a mark will see a lot of resistance. Why do I say that? Because the 76,000 call writers are extremely active. The highest number of open interest build up, and the recent change in open interest has been on the 76,000 call premium over 120 rupees order. Tells you that between 76,150 to 76,170, closer to the 20-day moving average, we will continue to see support. However, at lower levels, we will find some sort of demand come by as well. 75,800 put writers are fairly active. Currently, the highest change in open interest is what we've seen as 75,800 put, telling you support comes in around 75,600 to 75,700. And the maximum open interest is at the 75,500 put. So you put all of these data points together, you get a range, a decent 500-600 point range on the sensex for today's expiry, which is between 75,600 to about 76,170, 76,200 thereabouts. So that's the level, that's the range that everyone will be tracking on the sensex ahead of expiry tomorrow. Remember, tomorrow's ahead of expiry today. Tomorrow's a holiday, so the BSE options, weekly options, expire today.
Thank you very much for that update. We will slip into a short break. On the other side, we'll talk commodities with Manisha Gupta. Stay tuned. Welcome back. As promised, let's talk commodities. Manisha's joining in and she's got her eye on base metals. Manisha.
Thank you for that. Well, yes, as the other markets continue to consolidate, the base metal prices have continued to gain even in the trading day today. That is because the US dollar index has eased a bit. And when you look at the Chinese data, well, the last couple of them have come in on the positive side. The industrial profits jumped up by 18% on an year-on-year basis from January to April 2026. And that clearly has been a supportive factor. It also has to do with the equity markets. The tech-heavy index in US surged quite a bit. In the Asian markets as well, the equities have seen new record highs. So whether it is about the Japanese market, South Korea, all of that seems to be doing quite well. And we've seen records being hit onto those one as well. The other thing really is about the structural deficits that you have seen in most metals, whether it comes in from mining or smelting, have been supportive as well. It also is about the renewed optimism that we are looking at various industries, especially AI and technology-led, where most of these metals are used. And because the markets are looking at supply constraints and concerns here, you have seen a support factor come in because of that as well. So take a look at the US tariff holdings. US is stockpiling a lot of raw materials. This is a front loading that we've seen in sense of fearing import tariffs. That has been supportive. US and Iran could strike a peace deal. And if that happens, you could look at the metal prices and metal demand come back into the markets quite strongly. The speculative buying has been on the stronger side as well. So whether it has been about institutions, macro funds, they seem to be rotating money in hard assets, tangible assets, and metals seem to be doing quite well because of that as well. Various reports will tell you on how metals perhaps could be the best play in this year going forward. If you look at the copper prices, then we have seen strength there because there is a production concern there. Mines in Panama, Chile and Peru have seen ore grades go down. The cost efficiency seem to be declining. And with the kind of shutdowns that we are seeing around this has supported copper. Aluminum is another story. There are 3 or 4 major factors which have led to support. To begin with, it is China enforcing nearly 45 million tons of domestic production cap to manage the carbon emissions. This is the second straight year this is happening, and the Chinese mills already have hit 45 million tons in the previous year itself. And then the TRC charges also are trading at record lows. You also are looking at the West Asia conflict, which seems to have impacted 8 to 10% in sense of global aluminum trade flows supporting markets. The inventories should come in on your screens, and that would give you an exact picture, really. These are LME inventories globally. So when you look at copper, for 2026, we've seen copper inventories almost double on LME inventories in warehouses. But that picture, let it not fool you, because much of those inventories are lying in US, not being used and not available to the rest of the world, is where we are getting support from. Aluminum, the picture is quite clear with the kind of numbers we're looking at. Half of what we were in sense of inventories in comparison to last year. It has been nearly 37% of a decline in inventories, and that is what is bothering the street. And then it is zinc. Strong structural story here as well. Half of what we were in the last year, so 47% of decline in inventories here as well. And when you look at the prices, finally, the best of gains clearly seem to be coming in case of aluminum there, 23% up in this year till time.
Okay, all right, Manisha, thank you very much for that. Well, I think we'll take a quick commercial break here. Markets are holding about 18 points up at this point in time. Indianomics with Lata. She's going to be speaking with 4 trade economists on whether the spate of FTAs can one day bridge our current account deficit. So stay tuned. That's the panel you'll see in just a bit.